The election is on a knife edge, but markets seem calm. Welcome to Market Insight. I'm Elena Casas. With less than 3 weeks to go before the US presidential election, we might historically expect markets to be wobbling with uncertainty. But this year, they've largely continued to rise and rise. This week, upbeat earnings have sent the Dow and the S&P 500 to fresh record highs. But could there be clouds on the horizon? To find out, I'm joined now by Eric Sterner, CIO of Apollon Wealth Management. Eric, hello. You said in a note that markets are trading under the assumption of a divided government. What makes you think that?
Yeah, well, thanks for having me. And like you said, it's just been a very unusual election year because markets usually struggle with uncertainty leading up to an election, but the S&P is up over 20% through the third quarter. And there's a lot to like between the consumer being healthy, labor markets still strong, moderating but strong, the Fed reducing rates, and corporate profits looking very healthy. So I think while there's a very polarizing landscape with the political election, I think investors are betting on a divided government. And typically investors enjoy a divided government because there's more gridlock, so there's less of a chance of any legislation going through that's going to have major changes affecting corporate profits or increasing more uncertainty in the markets. So while we hear Trump and Harris go back and forth, I think that's what investors are counting on. There's a lot to like on the macroeconomic environment, because one of my concerns is if either party gets a clean sweep. I mean, they both have very aggressive, ambitious economic goals that are going to increase our federal debt. And I think the markets may, take a while to digest that if that comes about, if either party has a clean sweep come November.
How much do you think investors should be worrying about the scale of government debt? And indeed, does the amount of issuance make treasuries unattractive for investors going forward?
I think they should be very concerned. We have our debt levels right now at about 98% of GDP. And just looking at the Committee of Responsible Federal Budget had done some estimates upon Harris's economic goals and Trump's. Under Harris's, they're projecting that the debt will increase 3.5 trillion by 2035, bringing it to 133% of GDP. And under Trump, they're projecting 7.5 trillion added to the debt by 2035, which will bring debt to 142% of GDP. So I think under that I think our debt level right now is staggering. Neither party seems to be willing to address it. And I understand you don't win elections by saying, hey, I'm going to raise taxes and cut back on spending. But it is an issue that must be addressed, or else we're going to see higher borrowing costs and higher yields in the markets in years to come. So I think investors should pay attention to that. It's obviously nothing that's going to impact us in the short term, but in the long term, it really could affect the economic growth of this country.
Do you think, though, that the amount of treasuries being issued is a reason to stay away from them?
Not yet. We haven't gotten to that point yet. And I think that, it's a great environment in fixed income. After pre-pandemic, we were in ultra low interest rate environments where fixed income wasn't delivering the income that sometimes clients need, and they had to go to elsewhere, typically in more dividend oriented stocks. So I think there's a lot to like about the fixed income markets, and I'm not concerned right now as far as the Treasury issuance, but I just want to see, just like many people, a plan to bring down that debt levels so it doesn't become something that's going to affect our long-term growth.
The bond markets, of course, see the Fed having space for another couple of 25 basis point cuts this year. We've had some stronger economic data in the last couple of weeks, though. Are you confident there's still space for those cuts?
I believe right now that the Fed will cut 25 basis points at each of the next two meetings. And they're now in a bit more of a difficult position because of the two hurricanes, even the Boeing strike. There's going to be a lot of noise in those labor market reports. We've seen it in the last two weekly jobless claims where it jumped up But last week alone, it was up to 258,000 initially, but 35%, over 35% of those claims came from the states that were affected by Hurricane Helene. So the Fed really doesn't have, it's not going to have any more clean labor market reports before their next meeting. I do think that they will continue and along with their cuts, at least 25 basis points in November, and we'll see how the data comes out from there. But assuming that the data, the labor markets continue to moderate, I foresee potentially another 25 basis point cut to close out the year in December.
Thanks so much for joining us, Eric Sterner, CIO of Apollon Wealth Management. And that's your Market Insight. Don't forget, you can watch more videos on Reuters.com.